Imagine buying a house with no credit score, not a 620, not even a 500, literally none. That means millions of people who are locked out of homeownership or investing might suddenly qualify. Is this financial inclusion or the start of another housing bubble?
You know, it's interesting. I know this just dropped. I was actually, while you were announcing this, I was trying to pull up this news article while maybe Mitch rattles on, try and look it up next. But it's the guy that runs the FHA. He's, I guess, kind of, there's anonymous people at the White House that are talking about being pissed off at this guy because it kind of dropped. They sort of, I guess, they're claiming that he sort of bamboozled Trump into this thing. I don't really know the specifics of it. I can tell you that just eliminating minimum credit requirements, probably not a good idea. I think foreclosures or defaults are not good for the economy. We saw that in 2008. Do I argue with some of the credit reporting mechanisms out there? Maybe. But I think just at face value, just completely eliminating that requirement is bad, because if people can't pay off their TV loan or their, other sort of their credit cards or other things, that's a big responsibility, homeownership. So yeah, I think at face value, I think it's bad.
Well, isn't it just the initial look? Instead of this automatically disqualifying from them, doesn't this get this past kind of that auto this block of somebody even qualifying for a home? It's not actually just, hey, if you have no credit or bad credit, you automatically can get a home loan. It's just saying, if you have bad credit, if your credit is low or you don't have credit, that Fannie may look at other things besides just a denial automatically from being approved for a home loan.
Well, and that makes sense to me because, what if their credit's bad? They got hit with a medical bill and they've been good citizens. They've been paying their bills. And that's kind of where I was alluding to. Like, I don't necessarily agree with how people sort of like, you get one number, it's your credit score, and there's no sort of additional things that are looked at in your financial background. But I don't know the specifics of it exactly. So maybe, like, again, this is where Mitch babbles on. I'll try and do a little research on exactly what's happening with this thing.
So yeah, as I understand, this has to do with the desk underwriting, and it's a filter that they use. So before they're going to, you have under 620, they're going to kick you out. Now they're going to let you in, and it's going to look at all aspects of your financial sort of like situation. That makes sense to me. But if you go and loosen the requirements, that also invites in potentially bad borrowers. And I think housing's a right. I think debt is a privilege. Debt needs to be earned. You need to prove yourself that you can handle the debt. Otherwise, you're going to invite bad borrowers in, and we get the same thing that happened in 2008. Debt was handed out like it was a right in 2008, and unfortunately, we saw the whole thing crumble. So I don't want to see that either. I need to look into it more. I'm not totally against it, but I think we do need to be careful about who we're lending to. I
think so too. I don't think this is eliminating just like, hey, anybody qualify for a home. But the reason I like it, I think about back to when I started borrowing money, getting home loans. So I actually had great credit because I really never had credit, and I purposely built my credit because I knew I was going to start investing in real estate. So even though I had great credit, I didn't have a lot of it. I didn't have a credit history. I had never financed anything. Well, but my income was super low, right? So in 2005, 6, 7, when I bought my first 3 properties, some would say, hey, this guy maybe isn't a great borrower because I didn't have the income, even though I had a great credit score. So a great credit score, well, back then almost anyone can get a loan, right? But it didn't disqualify me for potentially purchasing a property. So that said, some people have great credit scores and don't have the income. Some people have the income or they've saved up money, whatever it might be, and don't have a great credit score. And maybe sometimes that credit score, they're building their credit. So it's like taking years to kind of build that back up, but they still have other attributes that could, potentially have them be a good borrower. I think the other side of that is, how much leeway is the lender going to have? If the desk underwriting is saying, under a 620 credit score doesn't disqualify them anymore, are we going to have these predatory lenders pushing people into loans and trying to push their bank to finance people that actually are not good borrowers? And that would be my biggest concern. So somebody maybe, has bad credit and the lender themselves are going, hey, let's get this person into a house because they actually make money on that, which is a very kind of dangerous spot to be. And I would really say just predatory lending. That would be my biggest concern in this scenario?
Yeah, I'm just looking at this. This is just Chat GPT. I actually feel better about it as I'm reading this. They're talking about, and this kind of goes into what I was saying earlier. I've never quite agreed with just the three credit bureaus. I thought that there's a lot of things that aren't factored in, like medical bills. Someone got hit with medical bills and they couldn't pay their medical bills, or some sort of tragedy like that. Or there's alternative ways to build sort of a credit risk assessment. And so they're talking about, just like we're not just going to just like stop the process. Step one, you're below a certain credit score, you're done. It's applying additional things like, have they paid their utilities? Have they done other things in their life that can prove that they pay their obligations? Also, they mentioned potentially bringing in other credit analysis or credit or equivalent credit risk evaluations, like, instead of just using the three bureaus. I guess there's some other people coming out saying, look, let's open up the way we assess somebody's credit. So I'm all about that. I mean, if someone's a good contributing member of society and they have a track record outside of just like paying their credit cards and there's some other things, let's look at it holistically.
To me, and I'm going to go a different direction with this, because I think that when you look at the government or any government agency, I'm careful to listen to what they say, and I'm more interested in what they do. So the fact that they're loosening underwriting via the DU, the desktop underwriting system, tells me that there may be some red flags in the housing market. In other words, they're like, look, we need to loosen up requirements and get more people into the housing market, more liquidity out there, more borrowers. So I'm curious, what do you guys think? Is this a signal potentially? Because anytime they loosen the requirements, I'm not a big believer that they're just behind closed doors going, hey guys, we'd love to have some people, with 580s get into the housing market. I think it's more like, hey, how do we make sure that these underlying assets are protected, and the bank's collateral, which is like you're sitting next to, bankers on your left and right who are lobbyists at the biggest level. They're going, how do we protect our collateral, keep growing this thing? Hey, we need to bring more buyers in. Okay, well, what does that mean? Let's loosen requirements. And I'm jumping to conclusion, but like, why are they doing this? What's the point?
I think you're dead. I mean, I think you're absolutely correct. Like when I hear you say that, it makes me really think one layer deeper. I mean, we went from low interest rates to high interest rates. We went from, high prices to a lot of markets are starting to pull back. It's, housing is unaffordable. It's hard for someone to get into a starter home. I mean, Trump announced, we just did an episode on this, a potential 50-year mortgage. And so, when I hear,
why are they doing the 50-year mortgage? Why are they doing this with DU underwriting? Like what is
I think it's the voter base. I think it's always been sort of a criteria for a healthy, happy country is homeownership. I mean, they've always talked about it. They call it the American dream is homeownership. And if I'm a politician and I know a lot of my voters can't afford homeownership, that's a litmus test to my happiness with leadership. So I'm going to start pulling all these levers. People can get into homes. Now I feel like I've achieved the American dream under this particular politician or this particular leader. I think it's more of that.
But to Mitch's point, you gotta watch less of what they say and more of what they do, because if the market is working like it's supposed to, you don't have to create all these new mechanisms. So the question is like, why are we talking 50-year mortgage? Why are we talking, loosening guidelines? And in the past, when guidelines have been loosened, it doesn't always benefit the individual or society as a whole. Oftentimes,
it's the same reason you hand out trillions of dollars to people and drive inflation up. It's for short-term votes. It's always short-term gains. They're not looking at.
It could be short-term votes, but it could also be trying to avoid calamity in the housing market. So for example, if they have forward metrics or, indicators or red flags that say, look, we have a problem, whatever that's caused by, then they're going to go into the back. They're going to go in the back room and they're going to adjust mechanisms or change legislation or whatever. And to me, they're not tightening the market, which they have before in recent, history with higher interest rates. They're doing everything right now to add liquidity to the market and make it easier for a buyer to buy a home. To me, that says that we're facing down the barrel of a potential problem in the housing industry. That would just be in my opinion. I'm not sure it's just for votes, because I mean, look, just a couple of years ago, they were at 8%. They weren't making it easier. They weren't loosening guidelines like the DU underwriting. They weren't. So to me right now is interesting because you've got 2 interest rates reduction, 25 basis points each. You have loosening in guidelines for underwriting credit score. You have the 50-year mortgage. What else are they going to come out with? And what else how else are they going to tell us?
Well, the credit score thing and the 50-year mortgage is coming out of politicians. Technically, the Fed is non-political. I mean, if you believe that or not, that's one thing.
Yeah, but you have to ask why. Like, why are they loosening up? Why are they doing these things? And even though I don't believe credit score is the entirety of someone's story and the entirety of whether or not someone should get a loan or not, it does play pretty heavy, because if you're borrowing money, I mean, your credit is really your history of showing that you're capable of borrowing and paying it back. And so even though I don't think that should be the only metric, you have to wonder, if they're loosening things up, is this going to be another 2008 scenario where in a few years, let's say they loosen it up and you get all these new buyers into homes, owner occupants or investors, into properties that either they can't afford or they don't have the ability to pay back, or they don't pay back. Then we're in another scenario where there's all these defaults. And then what happens 3, 4, 5 years from now? You have everyone going, this was so obvious. It was so clear. Hey, we loosened the guidelines. All these people bought homes that shouldn't have bought homes. Maybe it looks good in the short term, but it creates another housing crisis in the long term. So, there's two sides or more to every story, and this one will be interesting.
Well, I'm just thinking, I'm trying to just kind of think through how this would play out in my head. So right now people are stuck in homes because their interest rates are in the 2s or 3s. So there's not as much inventory. You've got the cost, which is driving up I guess it's driving up the value of homes, because you have low supply, high demand for home ownership. So the cost of getting into homes is expensive. Is this to get people out of maybe they want to get into a bigger house, but they're not leaving because they're in such a low interest rate? So maybe like, okay, are these types of 50-year mortgage and these types of things to get these sellers to start moving? It's to get more buyers into the market. I mean, like what are they seeing, Mitch or Gabe? Like, what are they seeing down there? What if the housing market freezes up and then people are stuck in renter land forever and they're unhappy? Like, what is it?
I don't think it comes back to like language like, hey, we want to help somebody get out of a home that's in a 2% loan, or we want to add more activity and we want to increase the transaction count. I don't think it comes back to that language at all, because I think it comes back to the thing that they care about. And they care about growing collateral or steady collateral. So these banks have a lot of debt on a lot of homes, and they want to not only have growing or steady collateral, right? So the underlying collateral is safe because they've bet on that. They bet on the American home, but also they want to be able to do more loans. So they want to get more capital out the door. And so for me, if I'm a banker, I'm going to say, hey, I want to know the loans that I sent out are good and steadily increasing in value. The collateral's good. So I have a delta there. I'm safe. And I want to be able to get more money out the door. I'm not sure that they're sitting here going, well, we really like, somebody at 600 to be able to get a home because we care about them. Like, I don't think that they care about them. Now, the other big sort of conspiracy, and people have talked about this before, like Blackstone, the other sort of consolidators, is that they basically go through these cycles where they loosen criteria. A lot of people get into homes, a lot of people get in trouble, and then there's a phase of consolidation when the market crashes. So we could be inside of one of those cycles as well, and I think we probably are. I think the short term though, the politicians, I'm not sure if they're trying to buy the votes. I don't know if I'm on board with that, but I think that they want, during their tenure, they do not want to see this whole thing crash, because guess what? That's the fastest way to hand over power to the other side. So if they're, and I don't know this for sure, but if they're staring down the barrel of a potential housing crisis, then they're going to do whatever they can to loosen guidelines, push the mortgage up to 50 years, whatever they got to do to make sure that more buyers enter the market.
What's the crisis though? That's what I'm asking. What's the crisis? Someone's sitting in a house that's $1 million in equity because the values, you're saying values are going to collapse if they don't bring in new buyers.
I don't know what it is, right? I don't know what the crisis is. I think it's up for interpretation, but it's behavior, right? If I'm like, hey man, as a friend, I'm like, hey, I'm going to go to work tomorrow. I'm going to do all these things. And you see me drive out the driveway and go underneath the bridge and take drugs. I'm doing something different than what I'm saying. And it's reason for question. That's what I'm saying.
Well, it's interesting when you're mentioning the banks are behind this. I'm thinking, well, we borrow from commercial banks usually, and they care about your ability to repay that debt, right? They do look at your credit score, but it's more the underlying collateral. These banks that are selling these home loans, it's all agency backed. it's all sold off. So their risk profile is zero. So if the feds are coming in and lowering that, they can originate more loans, make more money, get those loans off their books, and now it's the government's problem because they're guaranteeing these loans, right?
Well, why don't we do this? Why don't we earmark this episode? We come back in 6 months, even a year, and we see what the net effect is. Like, does this stimulate, more first-time home buyers? Does this stimulate, investment buyers in any way whatsoever? And, a few years down the road, does this put us into a complete housing crisis? We don't know what the net effect's going to be yet, but let's earmark this episode and come back to it and find out what the net impact of this is.